Um, Welcome to Hack the Bank, Strat- Strategic Financing for Growth and Contract by Edgar Darrell. I'm your host, Irene Cho. Today's topic covered access part one, the underwriter's black box. This webinar is brought to you in partnership with EWDD, BusinessSource Pico-Union Westlake Region, operated by Business Development Center and Gen West Capital. This webinar will be recorded and you may find it on our website, e-library, after a week. Just a little housekeeping before we get started. Please mute yourself during the webinar. We will have the last 5 to 10 minutes for Q&A session. So please ask the question during Q&A session using raising hand emoji or writing question in the chat box. So it's too late, so I'm gonna just jump in the webinar right now. Please welcome our guest speaker, Edgar Darrell.
Thank you, Irene. Good morning, everyone. I will be your presenter today. The topic, this is a four-part series called Hack the Bank. What it basically means is we're going beyond the credit repairs and credit scores, and we will deep dive into decoding what is in the mind of an underwriter whenever they process a loan application. So I hope you can see my slide here. We were having some technical difficulties earlier with me sharing, so I apologize for that. So the first topic that I want to talk about is what is the underwriter's role in the loan process? Well, for one, they are the gatekeeper of the lender. What that means is that they're not there to basically decline your loan or to say no. However, they're there to mitigate those risks. So this person is the one keeping the gates from your approval to the next step, in your working capital. An underwriter also check the vital signs of your company. What that means is that the underwriter will do a financial analysis on your company, look at your balance sheets, tax returns, personal tax returns, and your credit reports as well. A major part of their job is capacity analysis. What that means is that, in other words, it's just a simple way of saying, can you pay the loan if the lender approves it and funds it? So do you have the ability to pay? Another role that they go with is credit worthiness review. This is a look at your track record, both business and personal. So this is where the underwriter will pull your credit report and business credit report and make it a part of your loan package. Now, for contractors, this is also part of the underwriter's role is verifying your contracts. So they want to make sure that there is, a contract in place, it's been signed, and it's going to be part of their evaluation process. If you're offering any collateral, be it real estate or equipment, collateral valuation is also part of their job. A part of their gatekeeping role is to scan for red flags, for fraud, or any type of red flags that they can see in the file. So that's part of their gatekeeping job. And they also will set the rules as far as rates in terms of the loan when they see a whole complete package. In other words, they will give the thumbs up or thumbs down in your package. A hack for underwriters, this is a bonus hack for you, is if you're a contractor out there, if any of you is going on a contract, okay, this is what the underwriter will look at. Repayment certainty. What that means is that although you've signed a contract or a notice, an agreement of some sort, they want the underwriters, want a specific signed contract so they can include that into the file. The ability to execute, meaning it's in the contract that you have the ability to, let's say you were awarded a $5 million contract and, your previous experience is only like around 50 grand or $100,000. That may affect your contract negatively when you present it. So, you have to mitigate that by submitting other types of mitigants. For example, if your contract is, let's say, $5 million, and this is your first time to be awarded a big project amount, typically your amount is under 500,000. You can also submit your resume and other projects to show that you have the experience, not as much on the dollar side, but the work that you've done in your previous company or your existing projects. Also, they want to make sure that the profit margins are there. So, typically if they see a 15 to 25 markup or margin, then I think it's okay. But more importantly, they look at the signed contract per se. So a lot of underwriters, they don't even really talk to you until into the middle of the loan process. But the one thing that they're after is they want to make sure that this is a signed contract, basically. So keep those in mind whenever, especially if you're a contractor out there. Now, part of the business financing or business loan process, there's a cycle to it. And the basis for everything, the underwriter speaks a different language. In that language, this is a universal language for any business loan underwriter. This is their language. This is the 5 C's of credit. So this is your basis, whether your loan is 50,000 or $5 million. This is where they will look and evaluate your credit worthiness based on these 5 C's, which is character, capacity, capital, collateral, and condition. We will be going over each 5 C's shortly. And to begin, the first C that I have for you here is character. What does that mean? Character is not just, if you have a good image or reputation. It also includes your personal and business credit scores. So they measure it by looking at your Experian report, business credit scores, and also how you handle your business account. So that's important to them. When it comes to credit scores, CDFIs usually have a minimum credit score of 600, and major banks and some of the other regional banks out there will have a 680 or better. Now, CDFIs usually are lenient when it comes to credit scores. The only thing that they wouldn't touch is if you have some current delinquencies, or let's say you have some bankruptcies in your account within the last 2 or 3 years. Now, with the major banks, usually within, I would say, 4 years or 5 years before they can even look at your, even if you have a 680 or better score. Some banks would like to have your BK history as old as, say, 5 years or more than that. Now, CDFIs usually will have, CDFI stands for Community Development Financial Institutions. These are nonprofit lending institutions where their purpose is to provide the necessary working capital for the small business community. These loans are usually $500,000 or less. And PACE is a good example of a CDFI where they have allocated funds to lend to small business owners or general contractors.
Edgar, sorry.
Hmm.
We only can see your first page right now.
Oh, yeah, let me fix that. How about now? Can you see it?
No. Oh, now, yeah, it changed. Yeah,
Change?
yeah, it changed. Okay.
Okay, so what do you see now?
Character.
Okay, do you see the whole screen?
Yeah, it's good.
Uh, how about, okay, just the entire screen, right?
Not really, but yeah, we can see it.
Oh, all right. Uh,
Yeah, we can keep going.
okay.
Yeah. Yeah, the slide change is a little bit slow, so I don't know why. Yeah, please go ahead. Sorry.
Okay. So, let's see here. Okay, so as I was saying, PACE is a good example of a CDFI. They are an institution that provides small business capital and also provides counseling for uh, business owners in case they need it. Um, Character also refers to how you handle your business account. So what that means is that if your account has some history of non-sufficient funds or NSFs, they would look at it negatively. So keep that in mind, especially when you're handling your account. So they want to see, having NSFs probably, twice a month, maybe it's okay. But if they see, 4 or 5 or 6 NSFs history month over month, it's not a good sign. So I don't know if you can see this screen. This is a bonus hack for you. So if you scan that QR code, it will take you to Credit Karma, I believe, and you can order your credit report right there and then.
The
My,
screen is still character.
okay, it's slow. Yes. How about now?
Still character.
Now?
No.
Because on my end, I can move to the next slide.
Yeah, I don't know why, but it's still character.
Now?
Hmm. No, that's weird.
I know. I'm gonna stop share and then I'm gonna go back in, see if
Okay.
that works.
Okay.
Sorry about that, folks.
Okay, so yeah, we can QR code.
You can see now?
Yeah.
Okay.
And can you just in case, can you go next slide?
Okay. Okay. Are you able to see the next slide?
No.
So there's a lag time, but on your screen now you can see the QR code.
Yes, but I cannot see the next slide.
Okay. How about now?
No.
How about now?
It's still frozen.
Okay, because I'm moving my slides. I'm going back and forth. I apologize, everyone. I don't know what's happening here.
I'm gonna share the screen, slide later, but it's hard to process the webinar without slide.
Right, right. What if okay. Can you open my link that I shared you so you can,
I cannot do it right now because I'm in the webinar,
okay,
and then I have to you have to approve the access to the link. So it's kind of complicated. So next time you can just send me the slide ahead of time so I can present if you cannot.
okay, because on my end, I'm sifting through, my slides. So,
Okay. What do you want to do? Just keep going without slide?
well, yes, I can do that, but I can share my slides if anyone wants it. Later on, but we can continue. And then, if there's any questions, I can address that. And I apologize, but we need to move on. I don't know, what do you see now there? Are you still frozen
QR,
with the
QR code.
barcode? Oof.
Yeah.
Okay. What was my next slide was, about FICO score. So FICO score basically is a credit score calculated from good and bad information in your credit report. So how it works is that it's divided into several pieces where, let's say, amounts owed, new credit, length of credit history, payment history, and types of credit in use. So if you have a lot of inquiries on your report, obviously, and I'm sure you've heard of this, that your credit score is going to be low. Having too much credit as well will affect your credit score. Typically, what they look at is 35% on the payment history, how you handle your payments, if there are any 30 days or 90-day late in your accounts. Amounts owed accounts for 30% of it. So how much of a loan you have. New credit will be 10% of FICO. Length of credit history will be 15% and credit in use. So FICO score nowadays, I see on the average around 700 plus. A lot of lenders prefer that if you have a 700 plus, there's a good chance that you will get approved. Having said that, there are some CDFIs, like I said, that is willing to overlook that as long as there's no bankruptcies or any delinquencies currently. Regarding, I wish I could share this screen as well. Business credit scoring. I'm sure a lot of you would probably ask, what is a good credit score? There are several types of credit scoring process. There's no standard like your personal one. So with business credit, there's Experian, there's Paydex score, and there's also with Equifax. A lot of banks, major banks, use Experian. So if your credit score range is between 76 to 100, that means you're a low risk. So it means that there's a greater chance that you will get approved. Anything between 51 to 75 credit score on the business end of it is low to medium as well. So it's good. 26 to 50 is medium, meaning there is still a good chance that you will get approval. Anything below 25 is considered high risk. A score of 10 indicates that your business is considered a very high risk. What does that mean? The business itself accounts for, I would say 25% of that score. So if you're let's say you own a restaurant or you own some retail shops, or in the construction industry, those get scored a little bit higher than, let's say, a doctor's office or a manufacturing company. So payment history as well. They will also, part of the business credit report will also look at your what they call UCC filing, which is the Uniform Commercial Code Act. It's like, their security interest. Whoever lends you the money will place a UCC filing on your business. So they will have a priority lien in case your business go belly up. So if you have too much of those, then obviously you will get a lower credit score. But like I said, emphasis is on a business credit score between 51 and above. It's likely a good chance that you will get approved. Second, now we've discussed character. Now we're going into capacity. Capacity is if you're an existing business, it looks at your capacity to pay, how much money you have made in the past, within usually the last 2 or 3 years, plus your current year to date. Now, if you're just starting a business or been in business less than 2 years, in addition to your tax returns, they will ask, meaning the lenders or the underwriter will ask for your business plan, your estimates of projections, how much money you will make, and how much money you will need to spend. Of course, your projection should be, above, or you should show that you're making some money as part of your plan. This is the process. What the underwriter looks at is, they will look at your gross sales, or revenue minus your cost of goods sold. They will look at where your cash goes out, the operating expenses, and then the magic number is your net operating income, or net NOI. So it's your gross profit minus total operating expenses is your net operating income. Now you have that magic number. You will now compare that and analyze that against your existing loan payments and your proposed loan payments. So that process is called the debt service calculation, or DSCR. So what you do, and on my slide, I have a infographic of how it works. It shows your NOI divided by your total debt service is your debt service coverage ratio. So on that infographic that you will see later, if your score, DSCR score, is 1.15 to 1.5 or higher, means that you're in the sweet spot. So standard approval, there's a good chance that your approval will be, or your loan application will be approved. Having a less than 1 times of DSCR is probably a rejection. Not enough cash to cover your bills or loans. But like I said, the magic number, the sweet spot, is 125 or higher. The higher your DSCR, the better. The lower it is, the chances are not great. So we have character, we have capacity, now we have capital. So it's the money you have invested in your business. So if you've been in business for the last 5 years, it's those sums of money that you have as evidence in your equity. Where can you find the equity, if you ask me? It's in your balance sheet. So your total assets minus liabilities and net worth, or total liabilities minus total assets minus liabilities is your net worth, and your equity should be in there. Now, if you're a startup business or just about to start a business, your capital is your equity injection. So if you're buying, let's say, a piece of equipment for your business, um, some lenders, most of the lenders would ask that you provide at least 10 to 20% of down payment. So it's like your down payment. Think of it that way. So your equity is your down payment if you're a startup business. So a lender expects that you have contributed something to the business. So that's why, it's equity injection. In other words, you must have, and a lot of underwriters say this, you must have skin in the game. So less skin, less chance, I guess. So the more, the better. Now, people will say, well, if I have money, why would I get a loan? Right? It's true. Why would you get a loan if you have money? Thing is, it's part of your uh, capital strategy. Why would you invest 100% of your money where you can leverage your money and just use a portion of what they call OPM or other people's money, and keep your cash or liquid as a reserve? In that way, you have something, for a rainy day. So that's an explanation that a lot of people will get from an underwriter if they ask, why would I need a loan if I have plenty of cash? So it's a matter of leveraging. So a talk to with your CPA or accountant would yield the same information. So we have character, collateral, capacity. Now we have collateral. That's the fourth one that I want to speak about. So this is simple as it is. It's something of value that you own or will own from the loan, and you can pledge it to secure a loan. So if you're buying a piece of real estate or equipment, the banks will use that as collateral. So, and they won't use that 100%, meaning they will allocate a portion of that value, not 100%. For instance, if you're buying an equipment, say for $100,000, the assigned value or the lendable value of that equipment for 100,000 will only be, say, 65 to 75%. So there's a difference there of the true value and the lendable value of the collateral. So they won't give 100% or 1-to-1. They would always, have a lower valuation. Now, most lenders nowadays also require the business owners to personally guarantee the loan. So when you guarantee, it means that you promise to repay the loan even if the business fails, right? So not only if the bank will go after your business, they will go after you personally. There are some lenders out there that would do a waiver on guarantees. However, those are reserved for type A prime clients that they have. So they're willing to waive those guarantee. But in a lot of small business loan situation, a guarantee is always required by the bank or by the lender. Collateral will also be a backup for your repayment source. What it means is that in case your business goes belly up, the bank can take that collateral and sell it and recoup whatever they lend you and give you whatever's the rest. But in most cases, I'd say, a majority of the cases, if they take your collateral, you wouldn't get anything back because it's so depreciated that the bank will just get the proceeds 100%. The last but not the least of the 5 C's of credit is called conditions. It's a macro and microeconomic climate, state of the economy. So they're looking at inflation rates, interest rate trends, the GDP. They're also looking at the industry trends, looking at a specific sector, whether your business or your particular industry is growing, consolidating, or just stagnant. They also look for any upcoming regulatory issues or enacted laws affecting the industry. This is also the portion where the underwriter will look at your supplier and customer concentration. Now, going back to the macro and microeconomic climate, perfect situation now. So, the last year was a trying time for some of our major exporters and importers that's been affected by tariffs. So, a lot of lenders now are including in their loan package a questionnaire about how a potential borrower would address, the tariff situation if they are affected by it. Now, the current war in Iran will also affect this. I could see that happening within the next maybe couple weeks, where a lot of banks and lenders will evaluate what are the type of businesses that are going to be affected by this. Obviously, oil sensitive type of businesses that relies heavily will be they will raise the risk factor on that pretty soon. There are other factors to consider. So you got the tariff situation, you got the current war, then you have the inflationary rates. So what is this all affecting? So those are the types of things that as an underwriter will see and write about. I can see that maybe within the next several weeks or months, I can see that the credit will be tightening up a little bit. So, you got to check on your credit scores. Go into see what's the problem with your credit. You got to check on your business credit, make sure that you're okay there. You have to go back to your financials, make it stronger. In that way, when you submit a package, you have a better chance, because these are the times I can see that credit will be tighter, especially on new businesses or businesses that have been in for less than 2 or 3 years. So brace for that. However, there's still lenders out there that is willing to take the risk. It's just the rates will be a little bit higher, and the terms will be somewhat. There'll be other requirements before they can fund your loan. Going to the supplier and customer concentration. So the more customers you have, the more spread out your risk. If you have ARs or a lot of pre-work, then it's better for you. The trends as far as your business also plays an important factor when it comes to underwriting the condition part of the loan. I also have, and I wish you can see this, a infographic, a step-by-step commercial loan approval process from start to finish. So let me walk you through it, and I apologize again for these technical difficulties. Step one usually is the pre-screening and intake. So it's usually what they call the checkpoint, right? So, there's a gatekeeper and then there's a checkpoint, right? So what they look for there are, have you submitted your information completely? So are there any missing tax returns, incomplete schedules, missing contract awards, in details? So if it's incomplete, then the file is on hold and it stops. That's why you'll hear, and I'm sure for those of you that have applied for business loans, you probably would hear people talk about, oh my God, the loan has been there forever. How is that happening? I've submitted everything. This is not happening to me. Why is it? Well, you just got to go back and look at, the checkpoint. Did you submit all those information? Have you looked at the missing information request that they're asking? Maybe that's the holdup. So if now you have completed that, you can go and move forward to the next step, which is the financial spreading and analysis, meaning the standardization. So this is where the process will look at the numbers, reveal your cash flow, your margins, your debt obligation. So this is where one of the five C's is, being used. Whereas do you have the capacity to pay, right? Do you have the character using the credit score and business credit score that you have? So when you do that, you will have a financial spread. The underwriter will create that. Usually it's automated. They will just plug in the numbers and spits out, your what they call the debt service coverage ratio, which we talked about earlier. And the sweet spot, like I said, is 125 or higher. The higher your debt service coverage ratio, the better it is. If you pass that, if they still feel optimistic about your file, right? You're ready to the next step, which is risk assessment. So all of the five C's now will be applied into this risk assessment, not just the capacity, not just the credit. They will look at your capital, what have you given in the business, the current conditions. Are you an industry that's prone to uh, you know compliance issues, or are you a good business to invest in case of economic uncertainty? Like healthcare is a good example for that any banks loves to lend to healthcare companies or healthcare related, because they see that it's a business that can withstand economic uncertainty. They will also look at your collateral. Do you have collateral? If you don't, then what are the mitigants? How can you mitigate those for the lack of it? PACE is a good I'd say process when it comes to approvals. What they do is they will have buckets or criterias, and they are each assigned with a score. I believe with PACE, if your score is 20 or above, that means the likelihood of getting approval is far greater than having a lower score of 19 or less. So I like what Pace is doing on their underwriting is, they are incorporating that, the bucket system where your score, you get points for each of their criteria. So it's similar to the five C's of credit. So they will look at character, similarly, capital, capacity, collateral, and condition. Now, once they see those risks and they assess that, okay, this client or borrower is a good risk, then they move into the next step, which is structuring. So they will address those weaknesses and structure it in a way where it's favorable to the borrower and to the bank as well. For instance, let's say your cash flow is just right in the border of, the sweet spot. Let's say, like I mentioned to you, 1.25 or higher is a sweet spot for debt service coverage ratio. So what they do is, let's say your debt service coverage ratio is 1.19, which is certainly less than the magic number or their sweet spot, right? So what they will do is they will structure a loan to mitigate those risks. And how do they do that? What they'll do is they will, instead of spreading the term payment into like a 5-year repayment, what they will do is they will do a 7 or a 10-year repayment. So now your debt service coverage will now be a little bit in line with what they're looking for. So that's what I mean by structuring and mitigating those risks. This is also the step where they will identify who the guarantors are, what are the conditions or covenants of the loan. So the terms of the loan will be discussed, the interest rates, the monthly payments, prepayments, and all of that. Now, once that's been formed, okay, the underwriter will then write a credit memo. It's a narrative compilation of your total credit file, including financial spreads, risk assessment, structuring. Everything from step 1 to 4 will be in this credit memo. Usually the credit memo is, maybe 4, 5 pages. And depending on the lender, the underwriter will present this to their credit committee. Nowadays, in the old days, there is really a credit committee that looks at your package, and they usually have meetings every week or every month and discuss your particular case. Nowadays, especially with the larger banks, usually the credit underwriter will have their own approval limits up to a certain amount, so they can sign up on the loan once they're done with the credit memo. Now, if it's over their limit, then they can go to the next line. Usually, they will require 2 signatures to get approved if it's more than the credit limit of the underwriter. So basically, those are once that's been approved, then you go into the closing process. And you will sign loan documents, and then within a 2 day or so, you will get your money deposited or ACH into the bank. So I wish I could share this with you, but it's all available if you access it, and Irene can probably provide you with that. This infographics, it's helpful so that the process. As far as this is the by the way, the first part of the 4 part series. This is looking at the box where it's basically a POV of the underwriter. So the POV of the underwriter, basically, if we summarize what I talking about to you, is your credit score, your financials, your conditions will all come into play. And you must be proactive with your application, because that's one of the things that delays the loan process, is letting it slide as far as missing documentation, hoping that the underwriter will no longer request that. Those are the things that really it's important for them. And usually what they do, instead of not asking for it, your file gets put into a hold box, So it's not moving, right? So they're processing some other applications while they wait for you. So being proactive, get your credit report every 6 months to see what's in there. Make sure that your, I would say, your credit availability is under 50%. Or if you can, just avoid having too much open credits personally. Now, because you're a business owner, you can also apply for a business credit card. Usually, business credit cards, the credit limits and credit balances are not reported on your personal credit. And business credit cards will usually have a higher uh, credit limits. I know, I think US Bank and Comerica usually will have, beginning credit limits of 50,000 and up. I'm sure Chase does too in Bank of America. So it's one way of maintaining a good credit score, right? A lot of people in my business, I see a lot of borrowers that are struggling because they want to move forward, they want to get a loan. However, they have too much on their plate as far as their personal credit. So now it's dragging their credit score down, even though their payments are on time. They will say, Edgar, this is ridiculous. I've been making payments, for the last 10 years with my accounts. I haven't gotten any lates. But if you look at the credit report, you will see that there's too many credits open, small balances, high balances, and all of that. So that affects it. So if you talk to your banker, I guess a good way for you to start and maintain your good personal credit history is asking for a business credit card. And the rates are not, excuse me, not that high. It's reasonable enough for an unsecured business credit card. And usually, like I said, the lines of credit are usually higher on a business credit card. Capital One is a good source for that. I know Chase is good, Wells Fargo. You don't even have to be, as far as with Capital One, you don't even have to be an account holder, meaning you don't have to have a business checking with them to apply. American Express is a good source. Just make sure though that this is a corporate card as opposed to a personal credit card, because your personal credit is important because you also have your personal financial matters. If can you imagine if you have a 650 score and you're applying for a business loan and then you're applying for a home loan, you're spreading yourself too much, and chances are you won't get approved. But if you have a 700 plus score, right, and then you have a business credit card, your personal side won't be affected. You can do you can apply for a home loan, you can apply for a home equity credit line if you own your own home, and get approval. So in other words, the role of the underwriter is to make sure the risk is in line with the borrower's requested amount. They're not there to decline your loan. They're not making it hard for you. Although it may seem so, but their goal is to make sure that the spread of risk is there, and not being affected by the lender. It has to have a perfect balance between the risk from the borrower and the risk from the lender. If you have that, you will have a greater chance of getting an approval. So with that, I'd like to thank you for the time, and I apologize again for the technical difficulties. I wish I could share you those slides, but it will be available to you if you ask for it. So Thank you again. And if there's any questions, if we have time, I can take it.
Looks like we're good to go. Thank you for joining us today. See you next week. Thank you.